So there's been a rate hike with the Fed, and that announcement came yesterday. And so I want to go over that with y'all, but I want to start by letting Jerome Powell go over exactly what was going on with the Fed. And I don't want to play the whole video, but I want to go over exactly what it is that he said as it relates to the rate hike, why they did it, what the state of the banking industry is. I want to get to the money first before we start to get into all of the other things, right? Because everything comes back to the money. Politics, relationships, rate hikes, home purchases, credit cards, building a business, home, like anything that you can think of, raising children, it all comes back to the money if you really understand how money works, right? And so I want to go over this video. I want to play it, and then I want to mine out and give you my thoughts, and also give you some subsequent information. Mine out and give you my thoughts as to what this means, if I think it's a good thing or a bad thing, and how you'll be affected as a consumer and as a family. All right, let's continue.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses.
The first thing that I see him doing is actually doing the thing that Biden should have did, and actually telling you guys the truth on why it is that they went to save Silicon Valley Bank, why they wanted to reinstill confidence in the banking system, why it's important for you guys to really, really be focused on what's happening with fiat currency, why it's important for them to continue to fight inflation, because it all goes hand in hand. Biden came in and gave you this fluff story and said, hey guys, listen, we're building more jobs and you're insured or whatever, so on and so forth. The reality is that it's really the confidence in the banking system that gives the United States its power and allows for consumers to continue to really, really focus on and feel comfortable enough to continue to put their money in the banks, because that's the main way in which we generate revenue in the United States now. We don't make stuff, we just create wealth, right? It's magic. It's magic. But he's basically telling you, he said, listen, these isolated incidents and these banking failures that's become big news, right, based off of the fact that we now have social media and news travels much faster, and you can't really control it as much as you want to, as they did yesteryear. Banks fail all the time. Hundreds of banks fail on a regular basis during every administration. The difference is your confidence in the banking system is largely going to determine how it is that we move forward as an economy. And so he's really addressing the core issue of what people are really concerned about as far as the banking industry, why it's important for them to save that, because when it becomes national news, it then shakes the confidence of the consumer, all right?
That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system.
Protect the U.S. economy.
These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy.
Isn't it nicer when you can just get straight talk? It's much nicer when you can get straight talk. He just straight up told you. He said, listen, it's important that we ensure the safety and the confidence in the banking system, because that's the way in which we generate revenue for the U.S. economy and how we keep this thing running, how we can continue to kick the can down the road, because the national debt is continuing to go up. We're not going to stop printing money. We got to make sure that you guys are safe because it's a fragile system, and we're going to do everything that we can in order to ensure that your money is safe, or you continue to have confidence in the banking system.
Economy and monetary policy. Inflation remains too high, and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates.
I'm going to be reading super chats throughout the show. Shout out to Solomon Cannon. I appreciate you for the super chat. What he's basically saying is that, listen, regardless of the pain that you guys are experiencing, regardless of the confidence that we have to continue to instill in you guys, regardless of how much more it's costing you in order to buy a home, regardless of how much it's costing you in order to use your credit card, the cost of money is going up. All right. Now, for those of you that has not been tuned into me for the last 2 years, 2+ years or so, the cost of money is basically the use of other people's monies, aka the bank, in order to continue to build your businesses, small business loans, buying homes, consumer spending, using credit cards, so on and so forth, right? Because it's supposed to be guaranteed against the Federal Reserve as far as the safety and insurance, which is one of the reasons why they have that FDIC, $250,000, even though they go far and beyond that if it shakes the consumer confidence, because they need you to continue to spend money. When you spend money, when you buy homes, when you use your credit cards, that's the thing that props up the U.S. economy, because there's lenders and then there's consumers, right? The lenders are the ones that make the most money when they responsibly lend. Now, how does banking failure happen? Because they have to generate revenue. They also have costs, right? They have employees, they have systems, they have different vendors, they have all of these different things that factor into it, but often at times they are gambling, right? And when you make a decision to invest in something specifically that don't pan out, then you have to liquidate against those assets in order to shore up your finances, because there may be a lot of people that's defaulting, and there may be what I like to call the perfect storm, right? And the perfect storm is everybody is losing money, so they want to pull their money out the bank. But while they're losing money, you losing money, and so you don't have the liquidity to actually be able to prop up what it is that you're supposed to have for these depositors. So just to crash course really quickly, the way banking works is you put your money in the bank then takes that money and it lends it out to other people, aka mortgages, aka credit cards, aka small business loans, and so on and so forth. So when you hear a lot of these HOTEP, pro-black, different people that are a part of the different administrations that say we need to have more people lending over to black people, or we need to have more small business loans, or we need to do all of this and we need to do all of that. Well, first they have to go back to the foundation of how banking works in the first place, right? In order to have a black bank, you also have to have depositors, which you then have to have investors, and then you then have to have a strong business case for being able to put that money out, because you got to make sure that you can liquidate whatever it is that that person has leveraged against that loan, in order to make sure that you're not going to be left with your pants hanging down as a business if they can't pay back that loan. So, for example, when they lend out for cars, the reason why they repossess your car is because they got to get the money back that they lent you in order to buy that car that the finance company is depending on every single month in order to get that interest. The bank makes the money off the interest. Okay, they make their money off the fees, the interest. That's how they generate revenue. Okay, so if you don't pay your car note, then they got to come and get your car so they can sell it and try to get the money back that they lent you. You can't just keep the car and that's the end of the conversation. You don't own the car. You don't own a car. You don't own a house. You don't own nothing. As long as you are paying money into the banking system, or servicing the mortgage, or servicing the loan of that car, every day or every month when you get that banking statement, or you get that car note, right? You get your statement in the mail and you look at it. Most of y'all don't look at it. Y'all just put y'all stuff on auto pay. When you look at it and you look at how much is going to the principal, which is the actual car, how much is going to the interest, which is the bank, and then what other fees are you paying, such as taxes? That's how our system works. It's built on a house of cards and sand. And eventually, there has to always be a market correction, which is what you see in today. Because money cannot stay cheap. Banks do not make money based off of lending it to you at very, 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 very small rates. They make it based off of how much money they can make in interest over a period of time, which they want to lend to the people that can properly pay, which is why credit, right? Y'all care so much about credit. They want to look at your credit score and all of your other factors, how long you've been working at your job, because then that gives them a better view of how your ability to be able to pay back the money, right? They want to lend to you. They want to make sure that you stay a consumer and a borrower, and they want to use the gamification of credit in order to substantiate whether or not you can actually pay that back, right? So it's important for them to make sure that this banking system is safe by instilling consumer confidence, because they want you to continue to spend money and they want you to continue to borrow money. They don't want you to just spend the money that you make on your job, pay your taxes, and then continue to go, because then they can't make no money off of you. They want you to go to work, be taxed, spend money on credit cards, and then be taxed that way. And then come back and then create a business so that they can tax you 10 times over in order to make sure that you say, eat the rich, because if you pull yourself up by your bootstraps and you don't understand things from a business perspective, you're going to give half of your money away over into the federal government, which just continues to build their coffers. It's all one big circular pyramid scheme that the federal government uses in order to generate revenue so that they can give it to people that don't even care about themselves, and is going to finesse the system similar to how I taught y'all yesterday. All right, so let's continue.
Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate.
What's GDP for those people that's in the audience? What's GDP for the people that's in the audience?
And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with
Shout out to
employment
Zotang
rising by
TV.
an average
I'm going to be reading Super Chat shortly.
of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year.
So what he can't tell you is that the quality of jobs, it's not just about whether or not, yes, gross domestic product now, or gross domestic production. Now, the question that you have to ask yourself is, what is gross domestic product and how is it affecting us specifically? Because he's talking about growth projections, right? So one thing that he's not going to tell you, or one thing that he can't really break out, is the information as far as what type of jobs are being created, right? Because unemployment could be low, or job creation or unemployment filings could be lower than it was last year. But at the same time, is it beating the rate of inflation as far as the amount of money that a person is making when they get another job? Because as he just told you, right, job vacancies still exist. But what type of jobs are vacant? Well, it's two different types of jobs that's usually vacant when we talk about the U.S. economy. There's high-end jobs that people make a lot of money on, but the overwhelming majority of people don't have the skill set in order to fill those jobs. So what happens is we have to outsource, right? I've worked at every single company that I've ever worked at has always outsourced work, not so that they can save money, but because they couldn't find the talent to be able to fill certain positions, which is why even with all of these tech layoffs, You don't see a gnashing of teeth or a uprising of people saying, I can't find a job, similar to what was happening in 2008, because there were still so many different vacancies. It was just that everybody was going for the same particular job. So even those people that got laid off, remember that Asian woman that we were talking about that was on TikTok that was like, oh my God, I'm feeling so bad. I'm about to go over to Disney World and get a snow cone. I'm pretty sure that she found a job pretty quickly. Pretty sure. If you're a software engineer, cybersecurity, so on, all these other, there's always going to be a place for you in the economy, which is one of the reasons I tell y'all to get a foundation, a standard by which you can always lean back on. Because no matter what, I'm always going to be able to go and get that two, three, four, five, $600,000 position to be able to shore up my lifestyle. If everything just went crashing down and came down, I'm fine. I'm gonna be straight for the rest of my life, right? I have that shovel to always be able to maintain a lifestyle and maintain my standard of living, no matter what, right? The other segment of jobs that's available is very, very low end jobs, right? It's the warehouse workers, and it's not that these are bad jobs. I'm not dissing warehouse workers or blue collar workers and things like that. But what I am saying is that there will always be turnover. You will always be able to walk over into a Wendy's, Taco Bell, McDonald's, warehouse job, plant, whatever, so on and so forth, because now they're competing just to be able to shore up. So what they have to do is they have to like continue to introduce technology, automation, all of these different things in order to make sure that they keep things working. You can go over to the post office and get a job with USPS right now. You can go to the gas station, USPS. You can go to UPS. You can go to FedEx. You can go to any brick and mortar store. You can go to Amazon. You can go to any of these places to get a job right now. So unemployment is going to remain low, but the quality of jobs that's available, that's the thing that we start to have a conversation about.
Next year. Inflation remains well above.
Bruiser, you're not going Bruiser. Listen, Bruiser, I love the Lapeef show. I've done it for like the last 3+ years. But Bruiser, you got to understand, Bruiser, I have to work on the other things in the back. Hey, ain't this the greatest excuse ever? I got to work on the other things in the back end that generates more revenue for the platform. I need to be focusing on sponsorships. I need to be finding more people to put in a position of power. I have to give y'all if I'm on there, then that takes away another voice that can come up there and give some game that can probably speak more effectively to the different subjects that y'all talking about than I ever could. I'm not qualified anymore. I've aged out, Bruiser. I've aged, I've aged out, Bruiser. I have to work on the other things. You know what I'm saying? Let's continue.
Our longer run goal of 2%. Over the 12 months ending in January,
Shout out to Bruiser.
total PCE prices rose 5.4%, excluding the volatile food and energy categories. Core PCE, excluding those, core PCE prices rose 4.7%.
Let's see if I can fast forward this a little bit.
Risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
So this is really what he's saying. Well, let me let a little bit more play, and then I'm gonna come back to it.
At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation.
All right, so here's a translation, ladies and gentlemen. What's really being communicated is that regardless of how bad things become, regardless of how difficult it is for people to be able to pay their bills, the tightening credit markets, the ability to be able to get a mortgage at a specific payment instead of buying the house that's appropriate for your budget. Because y'all got to remember, we still at historic lows when it comes to interest rates, especially on homes. Interest rates used to be above 20% on homes. I know that sounds wild. Interest rates used to be very, very high on homes until they wanted to incentivize more people to buy homes in order to spur the economy, and then we got addicted to cheap money. I remember interest rates, or my father telling me at one point it was interest rates of like 16% and stuff like that on homes. And regardless of what the current interest rate is based off of the rate hike, in which we only had 25 basis points, which basically means that interest rates rose about 0.25% in order to continue to fight inflation. And one thing that we can't, because you're really stuck between a rock and a hard place, all right? What's really being communicated by him specifically is that you can't have high inflation regardless of what's going on in the economy and the banking sector, okay? What I'm telling you, specifically, you directly, is that the worst thing that could possibly happen for the U.S. economy, even worse than job loss, even worse than modern women, even worse than you specifically losing your job at any particular sector, depending on where it is that you work at, even worse than you not being able to afford a home in your hometown because that's where you grew up, is for inflation to continue to remain at a rate that is above 2, 3, 4%. It is bad. All you're doing is ruining not only your own future, you're eroding the value of your own money, and you're ruining the future of your kids and your grandkids. If ideally you want rates to be below 1%, but they always target this 2% rate. And I actually did a show on that, so you guys can go back and watch the show where I talked about inflation, why they try to have this 2% number. In an ideal scenario, you want inflation to be around zero. You don't really want deflation because you can have a destabilization in the U.S. economy. You don't want to have mass inflation, in which last year and the year before we experienced that because they was giving out stimmy checks and print money at a rate that was egregious because they were trying to prop up the economy based off of the pandemic and trying to come up out of that. So we have a mass manufactured gnashing and gnawing of teeth in which we're inflicting pain on consumers and the U.S. economy in order to drive down inflation, because there could quite possibly be nothing worse than both a combination of people losing their jobs and you have record high inflation. So you're going to have to pick one. You're going to have to pick a struggle, right? I'd rather be ugly than unfit. I'd rather be ugly than unfit, right? That's literally what he's saying. I'd rather be ugly than unfit. So the ugly part is they're going to have some problems and some trouble in the banking sector, and there's going to be some consumers that complain, and there's going to be some people that lose their jobs, and you're not going to have access to cheap money and so on and so forth. But he's saying that the U.S. economy needs to be fit. And he's saying that it's much easier to solve a problem when you have inflation under control, because it's the only tool that they have in the Fed's arsenal in order to make sure that they can control inflation within the economy. They can't say, yo, institutional investors can't buy up houses. There is no law for that. They can't say, well, we're forcing you to be able to hire workers. There is no law for that. But what they can do is they can say, listen, it's going to be much more expensive and you're going to have to be much more responsible, and you're going to have to tighten restrictions on who can and who can't get this cheap money. Because if you don't have the credit, and if you're largely dependent on credit in order to continue to maintain your lifestyle, you're going to have an issue. That's basically what they're saying. Here, let me give you another point of view, and then maybe you can better understand it from a C student's perspective. This is Larry Summers. If you don't know who Larry Summers is, I'll explain it to you in a minute. But let me get his perspective, because this will probably give you some more insight. And what I like to do is I like to compare and contrast different views from different networks in addition to the announcement, because it gives us more information to make an informed decision, all right? Hit a like for the YouTube algorithm, subscribe to the channel. I'm definitely going to be reading Super Chat shortly.
discuss this and more with the former U.S. Treasury Secretary, Larry Summers. Mr. Secretary, thanks so much for joining us. Did the Fed get it right today with this quarter-point hike?
By the way, I do think that the Fed got it right. I do think that they have to continue to raise rates. There's nothing that they can do about it, and it's largely based off of issues that we experienced previously. But I do think that they have to continue to raise rates.
I think of the difficult choices there were, this was the right choice. If the Fed had stopped raising interest rates when it clearly had a plan to increase interest rates, I think the risk would have been that it was signaling panic and alarm.
Yep.
And if the Fed was that alarmed, the market and everyone else would be as well. So I think carrying through was the broadly right thing to do. That was what the market expected the Fed to do, and I think it was appropriate.
So basically, what he's saying from a C student's perspective is, it's a couple different reasons why this was the right reason, or this is the right move from the Fed in order to raise rates. Right? You're always gonna hear people complaining because they want cheap money. Right? They don't care about you. They don't care about their future. They only care about what's happening right now. He's saying that A, it was necessary in order to continue to fight inflation, but then B, it was necessary to continue to instill confidence in the American consumer, because if they didn't raise rates, then that would have been a red flag, and that consumer confidence is waning, and that they had to instill more confidence in the U.S. banking system based off of everything that's going on. So it's almost like, listen, I'm not going to flinch just because I hear gunshots in the background, because then you're just going to show that I'm scared. Right? Have y'all ever ran up when y'all was a little kid? You ever remember that your parents said, listen, if you run into a dog, don't run. Because the minute that you start running, then the dog is going to start chasing you. That's largely what's happening in the U.S. economy today. The minute that you signal weakness, it breaks consumer confidence. The market reacts, and then everybody else think that something else is up because you're trying to save the. Think about it. One of the reasons. Two of the most recent in my lifetime major impacts in which we've seen rates basically go to nothing, right, was the 2008 crisis, because they had to make money easily available for people to continue to prop up the economy, right, and the pandemic. Everybody raced out to buy a house, which then made the housing market explode. Everybody refinanced in order to get a lower rate, right? People were buying houses sight unseen. They were buying homes at $100,000 and $200,000 over asking price with no inspection, dummies, with no inspection, because rates was that low, which then caused housing inventory to basically shrink up to zero. The other side of it was in 2008, 2009, 2010. Nobody actually had a job to even be able to go and buy a house, so they had to make interest rates really, really cheap in order for businesses to continue to hire people, reinvest in the U.S. economy, build things back up, allow for people and entities to continue to build out a stronger foundation for where businesses can go back and open and things like that. And so basically, consumer confidence is just as important as what is happening in the economy, because the minute that the sharks smell blood, they're going to come out and bite you. That's basically what he's saying.
I think the Fed is right to be signaling enormous uncertainty going forward. I actually think there are two possible paths. One is that there's going to be some real durability in these banking problems and the economy is going to turn down. The other is that this will be weathered and very much contained. And what the Fed's going to need to do going forward is going to depend on which of those paths we end up on, which I don't think anybody can know. I think the Fed was right to signal enormous uncertainty. I probably would have allowed more room for concern about inflation and left the door a bit more open to multiple rate hikes, given the strength of the recent inflation data, than the Fed did in their statement. But it's a very close call, and I think what they did was entirely entirely reasonable. A lot is going to depend upon how the regulatory authorities and the bank insurance authorities deal with the remaining bank problems out there and what happens in the banking system.
So basically, what he's saying is that it's only two paths to go down, and both of them is going to hurt. It's only two paths to go down, and both of them is going to hurt. You got to tackle the problem head on. And with continuing to raise the rates, you have to tamp down inflation, which also instills confidence in the economy because you're maintaining the same path in which you've already laid out that we needed to go down in order to fix what it is that we had as a problem in the first place. But the minute that you start wavering from that, you get off that path, it messes up consumers' confidence. We're going to have a market correction. All right. That's basically what this is all about. Everything and everyone has a false sense of security of what's going on in the economy right now. And what you're seeing right now is not the value of things continuing to go down. It's the value of things actually being what it was supposed to be in the first place. Housing was too expensive. People overpaid. They did it because they had cheap money. And so they looked at things based off of how much their payment was going to be, instead of looking at it based off of how much they were going to be giving over in interest over into the bank. It's just like a person that get a 96-month loan on a car. Sounds crazy, don't it? I think that a 60-month payment on a car is crazy. To be paying for something that is depreciating over time and giving interest to the bank based off of paying it for 5 years is insane to me. I've never done that in my entire life. Never done that in my entire life, right? But to think that you can pay 96 months, you can literally get almost a house at a 10-year mortgage for the same amount of time that you're paying for a car. And you can buy a car for $120,000, $130,000, $140,000, and you justify that by saying that, okay, well, my payment is only going to be X though, and I can afford it based off of Y, which is Y is the amount of money that you're bringing home after you pay your taxes. It's wild. It's wild that they're able to market this to you and get you guys to be able to buy into this. Somebody in the chat says, Anton, don't believe nothing that Summers is saying. It's not that I don't believe him. It's that I've already made up in my mind what I think the problem is and what the path needs to be in order for us to continue to fix what's going on in the economy, and that he's just substantiating the same thing that I'm saying. So it's not that I believe him. It's that I think that his views and my views align, and that we're going to have to go down this difficult path in order to fix what's happening in the economy. You got to go through some pain in order to get to the profit.